welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate all the comments, all the subscribers, all the support. It's been a phenomenal year, and I hope to continue next year. This week, we're going to look at Comcast, the media giant. We're going to take a look at their financials. We're going to see what they were doing in 2020. We're going to forecast a future and see what the economic return would be if we hold the asset over a decade. Now, what we're going to do is with Comcast and all of our investment, we look for 5 key attributes for everything. That would be top-line revenue growth. You got to have it. Earnings growth. We look at earnings as EBITDA. Must be there. Strong free cash flow. Less than 3 times debt to EBITDA, and a well-priced stock. Well-priced being EBITDA. Enterprise value to EBITDA is what we look for. All right. Behind me is the 10K for Comcast. We're going to go through in a second, but I want to get to a shareholder letter that's issued every year because I think it's really interesting. Behind me is the shareholder letter published by Mr. Roberts that summarizes 2019, but also looks back for the full 10 years of the decade. And I like the perspective. Both the 10-year perspective historically, we can judge the acquisitions that they have made, what has performed, and then going forward, what are they expecting? There's a couple things I want to point out here. First is the acquisition that they made for NBC Universal, which is right on the first page here. Today, NBC Universal is a recognized global leader of media and entertainment, and its EBITDA has nearly tripled since we announced our intent to acquire a majority stake in the company. So they bought a business and they've been able to grow it over time, which is a good metric for what management is capable of. Then here in 2018, they bought the Sky Network, right? That's a British communications network with 24 million subscribers. It actually owns or has rights to the Premier level soccer and F1 racing, and they believe that they can grow this EBITDA over the next multiple years. They think they can double the EBITDA, which is great to see. So there's 2 little comments in here. It's really full of all kinds of materials. Definitely go read it. And then he summarizes the last decade by saying that they have been up 542%, beating the S&P 500 over the decade. And when you look at their chart, it absolutely goes straight up, and kudos for them for being able to pull it off. So it seems like from here, the chairman, the CEO, is talking about what they've done in the last 10 years. They have definitely been able to roll up the business and expand. Let's go see how that's performed in the financials, and we'll go from there. Behind me is the 10K for 2019 for the fiscal year, and what I wanted to show you is a couple slides in here that I thought were pretty interesting. I'm on page 39 of the 10K, and it does a great job giving you 3 years of top-line revenue, earnings, and then some per-share data as well as you kind of look down the P&L. One thing I want to show is the adjusted EBITDA. They're calling it out nicely, and they do a very good job going through each of the divisions within Comcast and giving you revenue, EBITDA breakdown so you can do a sum of parts valuation if you want to. Sum of parts would be looking at all the divisions they have, looking at the EBITDA respectively for each division, and then adding your own multiple to each division if you deemed, for whatever value you deem that enterprise, and then adding it up. That would give you the enterprise value that we're showing. You could subtract the debt that I have and you get market cap. So it's a good, fun way to kind of come at value a different direction by doing a sum of parts. I'm not going to do it now because it takes some time, but I'll give you the tools to do it, which is basically right here on page 39. And then you continue to scroll down, and it breaks down each division as you scroll through. So here you go. Here, this section here, this would be the cable communications section. Okay, it gives you revenue breakdown. It gives you the EBITDA for the actual divisions over time, and you keep going. You'll get each respective division that makes up the portfolio that is Comcast. All right, before we get to the annual numbers, let's take a look at Q3 2020 financial results to get a gauge for what we believe 2020 will look like. We'll then take that annualized 2020 number, put it into our economic model, and then forecast forward to see what this value might be over the long term. And I want to say that the Comcast group does a good job breaking down earnings and revenue by division, as well as even giving us a stack up for EBITDA, which is what we look for in earnings. And you can see it right here, adjusted EBITDA. They're calling it out on the statement. And one thing I want to show you is this here, the reduction in EBITDA year to date, Q3 2020, 8.5% drop. So we're going to use that 8.5. I even moved up to 10% reduction in EBITDA from 2019 to 2020 in our forecast model. So we try to build a little cushion here in what this year, 2020, is going to look like going forward. The other thing I want to talk about really quickly, and I'll get to the numbers, they recently launched mid-2020 their NBC Universal's online subscription program called Peacock. They signed up in Q2 when it launched with 15 million members. Fast forward 3 months into Q3 now, they have 22 million members right there. So that's a 46% growth rate in 3 months of having that membership program, which I think, or the subscription program, which is very good growth, and I don't think they're getting credit for the possibility there. But let's go to the actual financials. Take a look at what they've been doing historically, what we think the value might be. All right, let's pick up as we always do with revenue. So as you can see, revenue here, $55 billion, $55.8 billion. These are all million USD. So $55.8 billion in 2011 has grown to $108 billion of revenue over this 9-year period of time. That's a 9%, 8-year period of time. That's a 9% annualized growth rate, which is a strong single-digit number. And for such a big company, it's a nice number to have. Earnings. Our metric for earnings is EBITDA. EBITDA has grown from 18 million to 18 billion to $34 billion over that same time period. That is an 8% growth rate, which is a strong single-digit growth rate, which is very nice, again, for such a big company. I was also surprised. I did not realize that they have breached the $100 billion mark in revenue. That's a tremendous amount on Jack. And a lot of their customers are subscribers in some fashion, either cable with cords or online with Peacock and so forth. So I think that stickiness bodes well for this number. And you can see it has grown every single year. A couple acquisitions here and there definitely boosted that number, but they are moving that needle north, which is really nice to see. And overall, I'm surprised just how large Comcast is. I did not know that. Okay. Revenue, EBITDA, definitely check the box, they're growing. Let's look at enterprise value and debt. So we'll start with enterprise value like we always do with debt. This is short-term, long-term debt plus capital lease obligations. $39 billion to $111 billion. That's a big increase over time, and it should be concerning to us because it's roughly two and a half, almost 3 times growth rate over a period of time when EBITDA has gone from 18 to 34. So remember, EBITDA has to pay back this debt. So the higher this goes, it's being sucked up by here to pay for it. So we want to keep those metrics. We're going to look at the combination there. But let's finish the table and finish off enterprise value. So debt is up, less excess cash. Excess cash they used to have on the balance sheet, it has gone away. So they've deployed the excess cash in acquisitions, which is reduced this number. It's also increased this number. Market cap. Market cap is shares outstanding times average share price. I'm using December's average because that's their fiscal year end when these numbers are reported. So I use that to calculate market value. I add this, less that, plus this, I get this. This is the enterprise value. That is the entire business, debt and equity combined in one single unit. What is that worth? That's the enterprise value. And that has gone from $103 billion to $316 billion over that period of time. Okay, now here's where it gets fun. We've got revenue, EBITDA, enterprise value, and debt. Let's look at some metrics and see what the value of this business might be. The first one we're going to look at is debt. Debt, right, that's the risk of bankruptcy as debt gets too high. Us as equity owners, if you're buying the stock, the debt guys are all in front of you if something bad were to happen and you had to go into bankruptcy or file some sort of restructuring. The debt gets paid first. The stock owners get the very last money if it's even there. So you always want to make sure you're smell checking how much debt is in front of the business. All right, and we do that by looking at this measurement of debt to EBITDA, and you want less than 3 times debt to EBITDA. That's generally where senior debt will play. A bank like J.P. Morgan, Wells Fargo, they will lend 3 times EBITDA on a business. So 3 times 18, that's how much debt they're willing to give. After that, it becomes much more expensive, or begins to get more expensive the more debt you need, because each layer of debt is an added risk of default. But you can see here that their debt rating has gone from 2 to 3.3 as they've taken on more debt for acquisition. So 3.3 is definitely above our mark, but it's not dramatically above, and it looks like it's coming back down. When I read some of their information, they are targeting to lower debt in the coming years as they pay off the big acquisition they made back in 2018 when they bought Sky. Okay, so debt, it's kind of like right there. Technically doesn't check the box, but it's so close. I'm going to go ahead and check that box, but barely. Enterprise value to EBITDA is our metric of value. It's basically a payback period. If this is the value that I can buy the business at right now, $316 billion is the value of the company, the price of the company, not value, price of the company. And I know the company generates $34 billion in annual earnings, and that earnings tends to be fairly constant. That's basically a payback period. If I bought it now, 9 years from now, this business will generate enough cash to essentially buy itself. That's a payback period, and it's incredibly important because this cash, this earnings, will translate to cash, which is what we buy, and it's also used to pay back debt, which is an obligation that must be repaid. So it's very important. And what you see here is it's low single digit, right up to 9.9, where it's currently sitting at. In my opinion, this is incredibly cheap. Certainly at 5.7, it's absolute steal, but a $100 billion company that's generating $34 billion of annual EBITDA, trading at 9.9 times is very cheap. Consider Disney, the Walt Disney Company, has less revenue than $100 billion, by the way. So these guys are larger than Disney. Disney's trading at, we'll look at Disney in a second. We're going to get there in 1 second. But just in terms of cheapness, I think there's a lot of value here. And what I like about it is your downside is kind of limited. If you look at this range, aside from this one anomaly, this range doesn't move too much. It's not like this 9 is going to go to a 5 anytime soon, and that's downside protection for you as an equity investor, which I like. All right, what I wanted to show you, I brought it up earlier, I wanted to show you just quickly where we are in this market because the market's getting a little crazy, and I want to smell check value. That's what we're trying to do, not get ahead of our skis. The Walt Disney Company right now is trading at 38 times EBITDA. They make $65 billion a year in revenue. This company makes $108 billion of revenue and is trading at 9 times, 10 times. That's a remarkably discounted value given the growth they have in Peacock and some of their subscription services. So Disney, definitely a premium there. Fox, very cheap. I didn't dig into it. Discovery, very cheap. Didn't dig into it either. Netflix, very expensive at 60 times. And Charter looks fairly valued to me in my book. Again, I haven't dug through the cash flows there or the balance sheet. That's just a quick smell check of enterprise to EBITDA for a benchmarking exercise. The next thing I wanted to cover is the debt. So we identified that the debt here at $111 billion is too high. We need 3 times EBITDA or lower. So what we're saying is they're going to have to outlay cash to buy that debt down. That cash means they can't pay it to us as dividend, so we're going to lower the cash flow forecast as they buy that down. How far do we lower it? This is what we do. I'm taking last year's EBITDA, $34 billion. This is my assumption. I'm putting a 3 times cap on debt. I'm saying they have to have the maximum debt of 3x. That's a maximum debt of $102 billion. They currently have 111, call it 112. That's a $9.7 billion buy down they have to do. When I look at their cash flow statement, we'll get there in a second. Last year in 2019, they made a roughly $5 billion pay down of debt. So I'm saying they can do that again, and they're going to do it 2 years in a row to buy down current level of debt to where they need to be. So we're going to haircut cash flow forecast by that amount because they have to buy down the debt. If they actually do it, that's their business. But for us, I want to make sure the numbers smell check that it's a good investment, hurting cash flow by this before we buy in. All right, let's take a look at cash flow. My favorite statement, your favorite statement, everybody loves the cash flow statement. So let's look at it. Cash flow from operations. That's the first third of the cash flow statement, the best third, the operating third. They have gone from $14 billion, $25 billion operating cash flow over that time period. That's an 8% annualized growth rate, which, by the way, dovetails extremely nicely to our EBITDA growth rate. What does that mean? That means that what they produce in the P&L, the earnings that they represent to the shareholders when they file the statement, that means they're representing themselves in cash, that they're turning their earnings into cash, that the earnings aren't necessarily fake or non-cash items. We want to see that. The next thing I look for is CapEx. CapEx is the money that they have to put back in the business to sustain and to grow. It could be new ERP systems. It could be new buildings to expand for personnel and grow. It's not big acquisitions. So if they when they bought Sky, it's not in here. If they bought NBC Universal from GE almost a decade ago, that's not in here. But this has some growth in it, but it's mainly systems and maintenance cap. But they spent $11 billion. It's up from $5.3 billion. What I like to look at is this spread. If they generated $25 billion of cash money from operations, and it's sitting in the bank at the end of the year, management sitting around the table says, what do we want to do with this $25 billion that piled up from being successful at doing what they do? I know, let's reinvest in the business for some growth to maintain our systems. Okay, there's $11 billion. Now, this difference, what is that, $14 billion? Mental math quickly worked. $14 billion left on the table after paying for maintenance CapEx and some growth money. What do we do with it? Well, we got to make a little bit of debt payment. This is what I was saying with $5 billion that they paid down debt the prior year, $5 billion. So they had 14, chunked down another 5 for debt. They get $9.6 billion. Call it $10 billion of cash money sitting on the table when it's all said and done. This is what we're buying. When I take a look at the shares and I divide this cash by this, this is the free cash flow per share number that you get every single time you buy a share, $2.12. That's a lot. The next thing I want to go through is the shares outstanding. This is important. You buy a share, you hang on to it. You buy it right now, or you buy it back then. Let's say take that back then. There were 5.4 billion other shares outstanding. And your percentage ownership, the one share you had was 1/504 billionth of a percentage ownership of the business. Okay, so you held your share over time, and time has moved on. And as the company has produced cash flow, and they had cash money sitting on the table after debt service, they have also chosen to buy back shares and cancel them. That has driven this number down steadily from 5.4 billion to 4.5 billion. That's roughly a $1 billion reduction, a 1 billion share count reduction over time. And there's roughly a 2% drop in shares outstanding, which is fantastic. So that means that your 1 and 5.4 billionth of a share percent ownership is now increased by 1 to 4.5 billionth of a share price. That's hard to say. The point is, by holding the share over the 8-year period of time, your ownership stake has grown. Now you have a greater claim on the cash flow, having done nothing, even though you didn't even get any cash out of that. Cash flow per share, share price average gives me a yield. When I look at the yield, 32%, obviously way too high. That's too high because they borrowed a lot of money to get the Sky acquisition done, so that's an anomaly. The 4.7 yield here is a nice yield. That's after that making that debt payment. So I think their current yield is probably someplace around 8%. Debt payment aside. Post-debt payment, it's about 5%. Okay, before we forecast forward, I want to make something clear. There's a activist shareholder, Pulse, Nielsen Pulse, who's bought into the business. If you put $900 million, which is a small percentage ownership of the business, but it's there. And he's trying to pressure the current CEO, Mr. Roberts, to sell off divisions of Comcast because he believes, the activist believes, that the sum of the parts is greater than the whole. And then by selling off different divisions, he can realize more value than is currently being represented here in these numbers here. All right. And I think that pressure is a good thing. That means that the activist is confirming with my analysis that he believes there's deep value here. I'm not sure I think that the owner, Roberts, who has 33% voting share of the company, is going to allow that to happen. I have a feeling the business is going to continue churning like it is, but I wanted to make a note that there is an activist trying to shake things up. That activist has been successful in the past in a couple other businesses, so it could be a good thing, but I just want to make that comment. Okay, now we've covered revenue, EBITDA, cash flow, debt, and the enterprise value. Let's go through and forecast and come up with what we think the long-term share price of Comcast should be. We'll then compare it to the financial markets and see what we can buy it for today. EBITDA 2020. Now we went through and we looked at the Q3 2020 quarterly report, and it said that year-to-date EBITDA was down 8.5%. So what I've done is I've haircut EBITDA 10% for a 2020 estimate of $30.1 billion. I then said that, okay, post-COVID, post-vaccine, we're going to have some rebound. So I'm giving them 10%. It doesn't get us fully back to where we were, but it helps offset some of the huge decline that they're currently experiencing. I'm then going to levelize at 6%. Why 6? Because historically they've been doing slightly north of that recently, but long term, I think the 6 is very doable for these guys. And I don't want to give too much credit to the forecast because some of it was acquisition driven, but I want to say that they can figure out how to grow the businesses, and a 6% seems a very reasonable target to me. Especially as they grow, they will have more room to borrow and more room for acquisitions. So what this does, it takes EBITDA from $30 billion to $53 billion by 2029. After that, I am then assigning a 13 multiple to $53 billion. It gives me $700 billion market cap. Why the 13? Well, I think this here dramatically underestimates the value of this business. It does not deserve a single-digit EBITDA multiple and has been largely undervalued for many, many years. And given where Disney and Netflix are with their subscription services, I think there's significant upside if Peacock does take hold and they continue to grow that business. There is significant upside for the market multiple perspective as if the business catches a bid. So I'm saying long term, it will grow to 13 times EBITDA and puts it at a $700 billion valuation. Less debt, which I've kept at 3 times EBITDA based on our earlier analysis, gives me a market cap of $537 billion. Divide by the existing shares outstanding, it gives me a $118 price target out in 10 years. Okay, we just forecasted EBITDA. Let's forecast free cash flow. So in 2020, I've got a 0 estimate for free cash flow. That's because with everything going on COVID and some of the declining EBITDA and debt payment they have to make, I'm going to say it's 0, probably north of that, but for to be conservative, I'll give it 0. 2021, $2.12. I am copying the 2019 number. This is 2019 results after debt payment. In their EBITDA forecast, I have us kind of springing back. So I'm using 2019 as a proxy because they make a $5 billion debt payment. That means they have $2.12 of free cash flow left over. They then grow that at 6% based on the EBITDA number that they've had, and I get $2.25. There's a big step up here, year 3. What happens? This is the $5 billion that they were paying down in debt. They no longer have to make it paid down because they're now 3 times debt to EBITDA. especially with the EBITDA growth that we're forecasting. So that $5 billion then becomes free and distributable, and it's a 50% bump in free cash flow. I then grow that larger number 6% with the rest of the EBITDA, and I get a long-term price target of $123 per share. That's a 4% free cash flow yield, by the way. Okay, so now we have two price estimates for Comcast. Let's take a look at what that means. So we've got one estimate, $123, another estimate, $118, two different methods. I'm going to average the two for $120 a share. It's currently trading at $42 a share. If we put this into an IRR calculation, so we get principal investment, I'm in for $42. I get a stream of cash flow that they may or may not distribute or pay off shares with, but it's mine as an owner of the business. And I sell my shares at $120 a share 10 years from now. This is the stream of cash flow. That is an 18% annualized IRR over that decade per time, which is above market for sure, and a very strong investment return for kind of a simple business. That is roughly 3.6 times cash on cash return on your investment. And this dovetails well with what they've done in the last 10 years, right? The last decade, as we read from the shareholder letter, that they grew over 500% over the last decade. This has them growing 360% over that next decade. So a little more conservatism, but it's definitely strong growth and definitely something you should consider adding to your portfolio if you're looking for a media company, something that's not quite as rich as a Netflix or a Walt Disney. As I always do, I give you a distribution curve. As time moves on, you can come back to this video and you can say, okay, I still believe in the long-term forecast, but the price has changed. What's the economic return if I buy it today? So $42 is 18% IRR. As the share price goes north, that IRR obviously comes down to 13% if you're buying it in the mid-50s. If for some reason it should fall and you're in the mid-30s, it's 20% IRR. Still a phenomenal buy, in my opinion. So in this channel, we're going to give this stock a good rating. Why? Let's recap. Top line revenue growth. Yeah, solid single-digit number. EBITDA growth. Yes, solid single-digit number. Strong free cash flow. Yes, it is. Low debt. Yes, it is. I'm giving the checkbox because they're buying it down. It's right on the cusp of the 3 times. And well priced. Absolutely. I think the stock is cheap. It has been cheap for a long time. It's not getting the recognition that it's due. And if it is to rise naturally on earnings, or let me say that a different way, not moving the market multiple too much, I'm going to 13 times, you get an outperform 18% IRR over a decade. If for some reason this should really catch a bit and move up to what Walt Disney's trading at 34 times, the price is much, much higher. And I can show you that right now. So if we take the EBITDA forecast that we have, right, we've got a price target of $53 billion in 10 years, but I'll show you this different. That's making a $118 valuation. If I were to move this to 34, I'll just give it a 25 times, which is still very high. Not as high as Disney or Netflix, but still definitely moving that bar way north. That produces a $260 price target, which is almost more, it's more than double what I currently have, being conservative at a 13 times EBITDA market multiple. So I think what you're looking at here is a good stock that has a decent amount of debt, but it's manageable. It makes cash. It's growing. It should produce a long-term market-beating return. And if it has upside and actually gets a bid, you could see a market multiple expansion, which would be even larger. In this channel, we look for something I call the trifecta. It's a phrase that I'm using. So the trifecta would be earnings growth like EBITDA, natural earnings growth, which these guys have, buying back shares, so share count reduction, which is your shares growing over time, which is what these has, and a well-priced stock, meaning the stock market multiple is cheap, and I'm expanding the market multiple over time. I think those 3 metrics actually lead to outsized returns, and it's what happened when we looked at the Domino's video You could buy it at single digit when it IPO'd. They bought back shares over time. They grew earnings, and the market multiple expanded. Those three things combined to magnify the return over the long term. And I think this could be an example of one if they can really capture that online subscription piece over time. So definitely take a look at it. I'm very eager to hear the comments on this one. Let me know what you think. My name is Cameron Stewart, CFA. This is Rational Investing, where we're buying cash flow assets. That's what we look for. Thank you very much. Please subscribe. Let me know what you think, and I'm happy to take recommendations. Thank you very much. Bye-bye.